The US dollar has long held a unique and powerful position in the global economy as the world on which outrests primary reserve currency. This status means that it is the currency most widely held by governments and institutions around the world as part of their foreign exchange reserves. The reasons behind this dominance are multifaceted, deeply rooted in both historical developments and the economic strength of the United States. Following World War II, the U.S. emerged as the strongest and most stable economy in the world. During this period, the Bretton Woods Agreement was established, which pegged the value of other major currencies to the U.S. dollar, which itself was convertible to gold at a fixed rate. Although the gold standard no longer exists, the U.S. dollar retained its central role in global finance due to the economic and political stability of the United States. Its wide acceptance across the globe makes it not only a medium of exchange for international trade, but also a benchmark for pricing commodities such as oil, gold, and other essential resources. This universal acceptance gives the dollar an extraordinary level of trust, allowing it to act as a common reference point in financial transactions across continents. The strength of the U.S. economy significantly reinforces the dollar's status as a global currency. The United States is home to some of the world's largest and most influential corporations, a highly diversified economy, and a financial system that is considered robust and reliable. Investors and governments alike are confident in holding U.S. dollars because they perceive it as a stable store of value. Additionally, the U.S. financial markets, particularly the Treasury market, are extremely liquid and large, which allows for easy trading of government debt and other financial instruments. This liquidity ensures that investors and central banks can buy and sell dollars at relatively stable prices without significantly impacting the global financial system. The dollar's strength is further supported by its role in international lending and borrowing, as many global contracts and loans are denominated in dollars. This widespread use strengthens demand, keeping the dollar valuable and reinforcing the perception of it as a safe haven currency. However, despite the dollar's extraordinary global standing and widespread trust, it is not entirely immune to economic pressures. One of the most significant factors that can gradually erode the purchasing power of the US dollar over time is inflation. Inflation occurs when the general price level of goods and services rises, which decreases the real value of money. In practical terms, this means that while you may hold the same nominal amount of dollars in your bank account, each dollar is capable of purchasing less than it could in the past. For example, what cost $10 a decade ago might now cost $20, assuming a persistent inflationary trend. While moderate inflation is often a sign of a growing economy, excessive inflation can significantly undermine the real value of savings and investments held in dollars. The Federal Reserve, which acts as the central bank of the United States, manages monetary policy to try to maintain inflation at a target rate, but inflationary pressures can sometimes accelerate unexpectedly due to factors such as supply chain disruptions, increased government spending, or rising global demand for goods. Another aspect to consider is that the dollar ES role as a reserve currency exposes it to unique dynamics. Because the world relies on the dollar for trade and reserves, the United States can, to some extent, issue currency and finance debt more easily than other nations. This privilege, often referred to as the exorbitant privilege, allows the U.S. government to borrow at relatively low interest rates and maintain a high level of consumption without immediately depleting its resources. However, this advantage also comes with responsibilities. Large-scale printing of dollars without a corresponding increase in economic output can fuel domestic inflation and, over time, reduce the dollar's global purchasing power. While other countries may continue to hold dollars in their reserves, a persistent decline in its value could lead to gradual shifts in reserve holdings, impacting the dollar's long-term stability. Furthermore, global economic developments can indirectly influence the dollar's strength. For example, during times of geopolitical uncertainty, investors often flock to the US dollar because of its perceived safety and liquidity. This flight to safety effect can temporarily bolster the dollar, even if domestic economic conditions are less than ideal. Conversely, when other economies are performing exceptionally well, or when alternative currencies, such as the euro or the Chinese yuan, gain more acceptance in international trade, there could be a relative decrease in demand for dollars. While such shifts are typically gradual, they are important to consider when assessing the long-term effectiveness of holding US dollars as a store of value. The dollar's short-term stability makes it an attractive option for many investors, particularly for transactions, trading, and holding reserves. Its liquidity and universal acceptance allow individuals, businesses, and governments to conduct trade efficiently and with minimal risk of exchange complications. For instance, international exporters and importers often price contracts in dollars to avoid the complexities of fluctuating local currencies. Similarly, tourists and travelers frequently rely on dollars when visiting foreign countries because it is widely accepted, even in places where it is not the local currency. This daily usability reinforces the dollar's practical utility and ensures that demand remains consistently high. Despite these advantages, long-term investors need to carefully consider inflation's impact when holding assets purely in US dollars. Over extended periods, inflation can gradually erode wealth if not countered with investment in assets that outpace inflation, such as real estate, stocks, or precious metals like gold. For example, if the inflation rate averages 3% annually over a decade, the purchasing power of a dollar held today could decrease by roughly a quarter within 10 years. This reality is crucial for individuals planning long-term savings, retirement funds, or wealth accumulation strategies. Consequently, while dollars are extremely useful for short-term transactions and a stable medium of exchange, relying solely on them for long-term growth may not be the most effective strategy. Another dimension of the dollar's global influence is its role in commodity pricing, particularly in energy markets. Most global commodities, including oil and natural gas, are priced in US dollars. This practice reinforces global demand for the currency, as countries must acquire dollars to engage in international trade. While this strengthens the dollar's short-term stability, it also ties its value to fluctuations in commodity markets. For example, sudden spikes in oil prices or global supply shocks can indirectly influence dollar demand and, by extension, its value. These dynamics illustrate that even a currency as dominant as the dollar is not entirely insulated from broader global economic forces. In conclusion, the US dollar remains the world's preeminent reserve currency due to the economic strength, stability, and widespread trust in the United States. Its global acceptance and liquidity make it an invaluable tool for international trade, investment, and financial transactions. At the same time, inflation is a persistent force that can slowly reduce the dollar's purchasing power over time, emphasizing the importance of strategic financial planning and diversification for long-term wealth preservation. While holding dollars is generally safe for short-term purposes, investors and individuals should remain mindful of inflationary trends and consider complementary investments to maintain and grow their wealth over time. The dollar's resilience and dominance are undeniable, but like all currencies, it faces challenges that must be understood and managed carefully. Gold has been revered for thousands of years as a symbol of wealth, stability, and security. Unlike paper currencies or digital money, gold is tangible. It exists physically in the form of coins, bars, and jewelry. It cannot be printed or created at will. This tangibility gives it an inherent value that is recognized across cultures and countries. People have historically turned to gold during times of economic uncertainty, political instability, or inflationary periods, trusting it as a reliable store of value. Its rarity, combined with the difficulty of extraction, ensures that gold remains scarce and highly sought after. Unlike fiat currencies, which can lose value due to government monetary policies or inflation, gold tends to hold its purchasing power over long periods, making it a dependable hedge against financial risks. One of the primary reasons gold is so widely trusted is its ability to protect wealth during periods of inflation. Inflation reduces the purchasing power of paper money, meaning that the same amount of currency buys fewer goods and services over time. When inflation rises, investors often shift their assets into gold because its value tends to increase as the currency weakens. This counter-cyclical behavior makes gold a popular choice for preserving long-term wealth. Central banks around the world maintain substantial gold reserves as part of their financial strategy, further reinforcing confidence in gold's stability. Historically, gold has demonstrated resilience even during major financial crises, economic recessions, and periods of high volatility in global markets, making it a symbol of financial security and stability. Gold's appeal is also enhanced by its global acceptance. Unlike certain assets that are region-specific or highly technical, gold is universally recognized and can be traded virtually anywhere in the world. This universality ensures that an investor's wealth is not tied to a single currency or economy. Whether in Asia, Europe, Africa, or the Americas, gold has an intrinsic value that transcends borders and political systems. Its historical significance, combined with its practical utility, makes it a foundational element of wealth for individuals, institutions, and governments alike. On the other hand, cryptocurrency has emerged as one of the most exciting and revolutionary financial innovations of the 21st century. Cryptocurrencies, such as Bitcoin, Ethereum, and others, offer a completely digital form of money that operates independently of central banks or traditional financial institutions. This decentralization is one of the key attractions of crypto. It allows users to store, transfer, and invest in assets without relying on governments or intermediaries. Cryptocurrencies also enable quick, borderless transactions, which is particularly appealing in an increasingly globalized economy. Moreover, the blockchain technology underpinning crypto ensures transparency and security, providing verifiable transaction records that cannot be easily tampered with. Crypto is known for its enormous growth potential, which has attracted both institutional and retail investors around the world. Many people have achieved significant returns by investing in early-stage cryptocurrencies or holding well-established coins during market upswings. The potential for high profits in a relatively short time frame is unparalleled compared to traditional assets such as gold or stocks. This has created a sense of excitement and opportunity, making crypto a magnet for investors seeking to capitalize on emerging financial trends. Furthermore, the cryptocurrency market is continuously evolving, with new projects, tokens, and technologies emerging regularly, promising even more innovation and growth in the future. However, the volatility of cryptocurrencies cannot be overlooked. Unlike gold, whose value tends to move gradually and predictably, crypto prices can fluctuate dramatically within hours or even minutes. Market sentiment, regulatory news, technological developments, and broader economic factors can all influence crypto valuations, often leading to rapid gains or steep losses. This high-risk, high-reward nature of crypto means that investors need to exercise caution and maintain a clear understanding of the market before committing significant capital. For many, the potential for explosive returns is balanced by the equally real possibility of substantial losses, which can be intimidating for those who are risk-averse or new to investing. Given the strengths and weaknesses of both gold and crypto, financial experts increasingly recommend a diversified approach that combines these two asset classes. By holding a mix of gold and crypto, investors can enjoy the benefits of both worlds while mitigating risks. Gold provides stability, reliability, and a hedge against inflation, ensuring that a portion of the investor's wealth is preserved even in turbulent economic times. Crypto, on the other hand, offers growth potential, technological innovation, and exposure to emerging financial trends, allowing investors to capitalize on new opportunities without putting all their wealth at risk. This balanced strategy leverages the complementary nature of gold and crypto. While gold cushions against market shocks and currency devaluation, crypto can deliver above-average returns and tap into the rapidly growing digital economy. The key is to carefully allocate resources according to one's financial goals, risk tolerance, and investment horizon. Conservative investors might choose to hold a larger proportion of gold and a smaller percentage of crypto, prioritizing stability and security. Conversely, more aggressive investors might allocate a higher portion to crypto while keeping a solid foundation in gold to hedge against volatility. In both cases, diversification ensures that the investor is not overly exposed to the downsides of either asset class. Moreover, combining gold and crypto can create synergies that enhance portfolio resilience. For example, during periods of high inflation or economic uncertainty, gold often appreciates or maintains its value, providing a counterbalance to potential losses in other areas. Meanwhile, during bullish crypto markets, the portfolio can benefit from rapid growth, capturing opportunities that would be missed with a gold-only strategy. By actively monitoring market trends, evaluating risk, and making informed adjustments, investors can optimize the performance of their mixed portfolios over time. It is also important to note that proper research, education, and risk management are crucial for successfully implementing a combined gold and crypto strategy. Investors should understand the fundamentals of both markets, follow credible news sources, and remain aware of regulatory developments that could impact asset values. Gold investments can include physical holdings, ETFs, or mining stocks, each with its own set of advantages and considerations. Cryptocurrencies can be stored in secure wallets, traded on reputable exchanges, or invested in decentralized finance platforms, all requiring careful management and understanding of security protocols. By taking these precautions, investors can maximize their potential gains while minimizing exposure to unnecessary risks. In summary, gold remains a timeless, tangible, and highly trusted asset, providing stability, protection against inflation, and a universally recognized store of value. Cryptocurrencies, by contrast, offer tremendous growth potential, innovation, and opportunities in a decentralized financial system, but come with high volatility and risk. By combining these two asset classes in a smart and balanced manner, investors can enjoy both stability and growth, mitigating risks while capitalizing on emerging trends. This diversified approach allows for wealth preservation, long-term growth, and strategic participation in the evolving financial landscape, making it an effective method for managing risk and opportunity simultaneously. As financial markets continue to evolve, the careful combination of gold and crypto represents one of the most promising strategies for securing and growing wealth in an uncertain and rapidly changing world.